Good morning. My name is Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm John Darsie, Editor-in-Chief, and together we bring you the Morning Call. So Scott, yesterday we got another slow, methodical move higher on the back of some good earnings from tech. Last week, bank earnings were enough to push us higher, and this week we have a heavy tech earnings week. IBM and Google were the ones that reported Tuesday night and helped us push higher. Last night we had some earnings from tech that were a little bit mixed. What do you expect to see from the market today with us down a few handles this morning?
I think a lot of people were coming in today thinking that we'd be down a lot more, and the market's taking it in stride. And the reason why it's taking it in stride is, like you said, you're having participation from all different types of sectors. And I know it hasn't been the sexiest rally, and a lot of the names have been somewhat safe. But overall, if you follow trends, whether it's whatever sector you're actually going with, whether it's the financials, whether it's the industrials, whether it's the refiners, whether it's just the S&P, everything is somewhat following the 8 and 21-day moving average. Now, John, every time we talk about the 8 and 21, people are like, why do you follow it? I'm like, because that's the trend. And for me, to follow that and hold the portfolio approach as long as we're above it, that's what's been working versus trying to figure out if the low volatility is a reason to get out, the lack of volume is a reason to get out. All I think you have to do is follow those moving averages within whatever sector you're trading.
Yeah, it may sometimes seem like we're beating a dead horse talking about the 8 and 21 period moving average, but the point we're trying to make is that there's no reason to really do anything unless we break below those moving averages. It might be a little bit frustrating for intraday traders, the lack of volume and volatility intraday, but for swing traders and investors, this is great. We're seeing the calmest seas that we've seen in years in the market, and I don't think that's a negative thing from a long-term perspective.
Right, and if you take the time frame analysis, which is what we talk about, we want to talk about where do you live. Are you a macro investor? Are you an intermediate swing trader? Are you an active cash flow participant intraday? There's been something for everyone, but it's certain rallies, like certain trends. I remember last year at this time, we were following the intermediate trend in the first quarter, but that rally was a lot different than this rally. It was following the 8 and 21-day moving average as well, but during that rally, tech was leading. During that rally, I think the Russell was acting well. But during that rally also, I don't think the banks were involved, and I think the OAHs were weak, so it was different. Whereas, in the summer when we started again, then you had the banks, rallying and showing relative strength, and now so far in 2013, it seems like there's more money rotating to some of the refiners, some of the distillers, and the industrials have been just on a tear.
Yeah, and let's go ahead and talk about Apple. That was obviously the big news last night. The company is sold off from above 700 to below 500. Making it seem a little bit like expectations were low going into this earnings report, but the company wasn't even able to meet those lowered expectations. They beat on EPS slightly, but they missed on revenue estimates and iPhone sales estimates, which were two big barometers that people were watching on the report. We've talked a lot about how the market has been able to absorb Apple weakness over the last few months. Do you think that's something that can continue? I know the futures are down a little bit less than people might have expected given the size of Apple's sell-off after hours.
Well, Apple's gone from 700 to 500, and the market's at highs, and now we're down about 10%. And I know the NASDAQ futures are lower, but despite a few, S&P futures are down 3-4 handles. Dow, I think, is flat. So the question is, how do you approach Apple today? And in our sector spotlight, we're going to go over the earnings of the past 2 days on how to handle the action moving forward. So today with Apple, it being down almost 10%, you look at the chart here, you have to have a plan. Okay, hopefully, from this head and shoulders top right here, you got out of some of your investment in Apple. Or for me, when it broke the 21-day moving average, okay, that was a signal for me to get out of the way. And then from there, it showed relative weakness the entire way down. I know we had a nice little red dog reversal right here for cash flow. Okay, but then what happened? It got contained by this descending trend line. Then it came all the way into 500 again, got contained. Then we had the low 483, tried to bounce, got contained. So coming into this report, I know for me, I'm risk averse. I didn't want to own Apple. I didn't want to have it short. I figured perhaps if Tim Cook did something different and actually had a strong reporter put some kind of catalyst in there, which he didn't because all he did is do a small dividend, perhaps we can get back to 550. So with that said, John, to a call spread, because what is a call spread? What's your risk?
For you, I know you took a $5 risk to make 20, and we always talk about risk reward. So.
Well, the risk is premium paid.
Yeah.
Okay, instead of owning the stock, closing your eyes, going underwater, and blowing up. And during earnings season, you never want to do that as a trader, not even as an investor. So, risk being premium paid. It's unfortunate that it went the wrong way, but now I can come in with a fresh head and say, let's see what type of gap down we have. Does Apple gap down 50 points and close down 20, which I would think would be a great trade for traders, or does it gap down 50 and close down 60, which won't provide that much opportunity? So I want to show you one thing on this chart real quickly, because if you remember about 2 quarters ago, just show you a different type of gap down. If you remember here, okay, this was when Apple gapped down, and this is what you had here. It gapped down, closed a little bit off the lows, and then within a day or two, it then filled the gap, and that's what helped ignite a run for Apple, okay, because this gap did not control it. All right, so now it's going to be a little different. Obviously, we're in a little different time frame, so you want to always judge things a little bit different. Here we are. This is resistance. If it tries to rally back up, see if 483 will contain a rally off the lows. Aftermarket 457 was where it bottomed. So I'm going to write down 457, 474, which is the pre-market high, and 483, and see how we could trade it within that range. And if it doesn't rally at all, the next real level is this gap that comes in right around here, which is right around 440, 443. So today, I think Apple just has a lot to prove, and it should be a level versus a level. It's not the day to come in and short Apple with any kind of force bearing the fact that we just went from 700 to 500 to 465, but it might not be the day to buy with both hands. It's the day to be flexible and do just a level versus a level.
There's a lot of things that might come into play today with margin calls, with Apple, with hedge funds selling out. There's a lot of question marks, and like you said, I think it's best to wait for Apple to prove itself. We talk about not taking equities into earnings unless you have an ultra long-term perspective. And that's something with Google and IBM. They had good reports, but we like to judge the trade going forward based on how much of the gap holds, like you said. Google and IBM both, like we said, had strong reports. They held their gaps yesterday. What are you looking for as a potential new buy signal for those stocks after those gap ups?
Well, when you want to see how much they hold and how many days it takes to consolidate before it continues, and that gives you the speed and composure moving forward. So let's get into IBM first. Very solid report. Let's just go to the chart. Remember last quarter, it closed high, expectations were up there, it gapped down, and then from there did not fill that gap. So from where it opened at just say, what was that, opened around 201, you wound up having like a 2-week move all the way down to 185 because the gap did not get filled. Okay, so with that being said here, okay, look at a different story here. You now have the gap to the upside. So here's your new range. If for some reason it starts breaking below yesterday's low of 203.36, I'm sure some short-term guys are probably going to be fading it or shorting it into this gap to see how much the gap holds. But then if all of a sudden you get some kind of reversal, at some particular point in here, and then you could trade long versus the gap, and then at some point after consolidation, it takes out the highs here, and then it could take out the highs of the year. But all in all, you want to see how long can it stay above this gap in order to keep the pent-up momentum for potentially a new move. And then real quickly with Google, same type of strategy. Google, you had a nice gap up yesterday. Here you go. So there's a lot of pent-up momentum in here. What I'm going to look at today is to see how we handle yesterday's low, 735.79. If we trade below yesterday's low, let's see how much of the gap it fills. Hopefully it doesn't fill a big portion of it because that'll keep this very bullish. And if it holds this area and doesn't even attempt to get in the gap, then you'll just know, how strong it is, and then it could potentially take out, this 749 and continue. Now I'm just going to show you one other thing that I remembered back from Apple. Just way back when. This is just to show you the pattern here. Remember what happened here with this gap up in Apple? Okay, this was if you didn't take Apple into earnings, okay, just give you an example. Yep. Gapped up, it waited 4 days, didn't fill the gap. Once it crossed this 3-day high, here was a nice entry, and then once it crossed above the day of the earnings high and held above it, it followed the 8-day. So that's how you use a gap after earnings in order to get involved and stay with it moving forward. And it could happen on both ways, a gap down or a gap up.
And the last stock we'll focus on in tech was another one that reported last night and was on the complete opposite end of the spectrum as Apple, and that was Netflix. The stock, had bottomed out last year just above $50, had rallied up. And then last night, they blew earnings estimates out of the water. They were expected to report a 13-cent loss per share. Instead, they reported a 13-cent profit. Guidance, rather than guiding for a loss next quarter, they guided for substantial gains, or at least gains. Revenues beat expectations as well. The stock is up almost 40% after hours, just a blockbuster move. What are you looking for from Netflix today?
I wouldn't say you look for much from the short or long side, because whenever you're up almost 40% with a heavily shorted float, it could go higher, but when do you chase a stock that's up 40%? So at this point, investors that sat in this report, who stayed with it, congratulations, Carl Icahn. I think he, filed for this way back when. And then if you took a call spread here, you're getting paid. If you took a, a call, type of formula for it, you're getting paid. And then also, if you took a put spread, congratulations. Congratulations, why? Because you did risk is premium paid. If you're like, you know what, Netflix is not going higher, it's at the highs of the year, it's a broken stock, broken model, and you said, instead of shorting the stock, which you could have got your doors blown off, you said, I'm going to buy a put spread because risk is premium paid. Big deal. It's a cost of doing business. So if you look at the chart here at Netflix to see where we are now, this was the prior pivot. This prior pivot right here was 133, which we got above. Actually, this was one level, which was about 121, which it blew through. Then you had your 133, and now, this is your next level, which I think many people are raising the price target to, which is right around, 154-ish or to 160. So I do think with this type of report, you could see further upside, and it'll be great to have Netflix back in our trading plan a little bit more consistently, because when it moves, it moves well, and we could potentially make some money there. But on this open, it's the same type of thing. Let it gap up, let it create a range, maybe trade it a little bit back and forth. Like if it put a high in, maybe short a little bit versus a high for some cash flow, or if it pulled in, put a low in, and you want to buy it versus that low. That's how you treat these earnings plays. But then once you have a nice little range, then you can get more into a swing type position.
And one thing I'll add real quickly about Netflix is that the stock has a 24% short float, which is a huge short interest in the stock, and is fueling a lot of this rally that we're seeing after hours. Is that a lot of people did take the equity into earnings, and those people are getting burned and forced to really cover and try to limit their damage right now. So that's why I don't think it's prudent to try to look to short this stock, even though it's up almost 40% after hours. A lot of those shorts could still be trapped and get squeezed, so you could see any number of scenarios from Netflix today. We're going to do a quick commercial break, and when we get back, we'll go over the transports and some other sectors.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.
Scott, one thing that we've been focusing on a little bit on our blog, and I know you've been trading at the virtual trading floor, is the transport sector, which Dow theorists consider transports a leading indicator for the economy. You got to start shipping stuff before economic growth really starts to pick up, and it can show growth before you see growth from some other sectors. And so in one vein, that's positive, but the shippers have also been a little bit extended recently. I know you've been talking about looking for a cute short in the transports. What do you see from the IYT, which is a sector ETF?
Well, if you recall a few months back, you had that huge descending channel, which was very indicative of higher prices. So you could always see something. And with that said, as you try and expand your time horizons or expand your sector horizons, that was a good time to turn to it. And it was also a healthy sign for the market. So you look at the chart here of the transports that we don't know that well. You don't have to know it that well to see this descending channel that was going on for months and months and months and months. Then finally it broke above 92. All right, gave you a nice little breakout, retest, and then pow. And also, what did it do? Oh my goodness, it followed the 8-day moving average, just like the spiders. Well, anyway, you look at it where it is right here. It's really not a blaring sign to potentially short it. So at this particular point, that high of yesterday, which was 102.60, I used that as a pivot where it pushed above, came below. So I'm short a little bit. I'm not going to be stubborn. If it gets above 103.03, I'll get out of the way, because a lot of people have been trying it this whole way. For me, I haven't really touched it, so I figured it would be a decent sign to look for a rest. And if it doesn't, I'm out. If it, I'd like to see it at least let the 8-day catch up and come into 101. But overall, the thesis here is, John, is that there are a lot of other stocks that are on the move, and if you're caught looking at the old names that you don't, that you're used to but aren't performing, look at other names, because all they are is names and symbols, but the charts still tell the story.
And the 2 biggest components of the IYT are 2 railroads, Union Pacific and Kansas City Rail, KSU. UNP is the biggest one. They have extended charts, and setups, sort of the way the IYT do. Take a quick peek at those and
I just want to show you that, again, these charts, if it was a tech name, traders would have been excited, but because it's UNP, no one looked at it. So if that's you just got to change a little bit. If you look at the chart of UNP, played by every other rule also. You had your nice gap up right here. All right, so what happened? The gap didn't get filled, so that's a pro gap. That's giving it a new ignition, so to speak. You could have bought right here, nice tight pattern, and then right above this, what is this, 132, it extended. And what did it do also? It followed the 8-day moving average. So you didn't have to care that it was UNP. All you had to know is you had a gap up, didn't fill, followed the 8-day moving average. And then you just mentioned KSU. Let's see what that looks like. Oh, what a coinky-dink. Looks kind of similar, where you had a gap up. This one took a little bit more time, didn't get filled, held the 8-day above the 21-day, and then another gap up where it extended. So these are two nice patterns that still, if it was a different name, and it wouldn't really matter. But as long as you know the pattern, it doesn't matter that it's KSU, so to speak. So at this point, maybe some of this move is over, but it shows you that you got to keep scouring different names, even names you don't know, because the patterns repeat themselves and they still have similar action.
Yeah, like you said, it's all about price action. The more diversified shipping plays, UPS and FedEx, are also components in the IYT ETF. And those have a little bit different setup than the railroads. Those aren't as extended. They have sort of technical setups. Let's take a look at both of those charts, FDX and UPS.
Well, FedEx, if you take a look at it, let's go right to the chart. Here was your gap up, okay, and then what did it do? It held above prior resistance. So that showed you that you could look for involvement there. Here was your add-on play. And then from there, it just continued all the way to where it's consolidating now. So for FedEx, I wouldn't chase it up here, but overall, it's still following the 8-day. 21-day would be nice to play a little catch-up. Yesterday was a little weak when the market was strong. I wouldn't take too much into account there, but the longer it stays above, just say this 98.41, you have to also get earnings out of the way. The better the chance it absorbs this big move, and then some momentum comes back, above 170. If you go to UPS, you will see this also really nice run. Okay, name that not a lot of us trade. Here's a gap up, never even came close to it. Here's your bull flag, above this prior resistance, and then it went. Okay, yesterday you had a small little reversal, so that might lead to a move down to the 8-day, which is around 79.54. But overall, if you want to start watching these names, I think there's action there, and it's probably prudent as some of the other names are just not trading the way we like them to.
All right, we're going to go into some quick hits here, some more stocks that have reported earnings recently. Western Digital is a hard drive company, basically. They reported before the open this morning. And I don't think it's been terribly active pre-market, but let's take a look at the chart. It's another one that maybe looks like it's due for a rest.
This one, Western Digital. In tech sector, Western Digital and Seagate have been unbelievable. Both of these have been leading. They've both been in IBD 100 or IBD 50, whatever it is, and both also, are a bit extended. So if you go here to Western Digital, I'd like to see what they reported, but we came in here, so I'm not exactly sure. Here's where it's at. Here's the 8-day, following it along above the prior highs. I bet you if we went to, hold on, let me just do something real quickly. We go to, where's time templates on here? Time templates, top there. Go to West Coast. No.
Yeah,
all right.
Trying to look at the after hours.
Yeah, let's go to, actually, all right, but Darcy, you do that, just to show you where it's trading now. All right, so it's gapped up. So Western Digital, 47.50, okay. So at this point, let's see, go back to the daily, and where is that? That's a little bit above the high. So anyway, it looks like it's taking it in stride. You go to Seagate real quick. Stock also, another nice trending, another nice movement in tech sector, which has been hard to find. And there you go. So, Seagate and Western Digital, I would just kind of let it sift out after the earnings.
Another stock that reported last night and is up after hours is F5 Networks, one of the cloud plays. Those are stocks that are on traders' radars often. What do you see from FFIV?
I think it's nice to see that this was like somewhat of a laggard cloud computing stock. It hasn't been leading, but coming off the lows, it's up like $4 or $5. Same type of scenario here where it's gapped up. You want to see if they try and sell it down. If they don't sell it down, then maybe it can continue. You look at the chart here, and these are levels that you should be watching. It closed at 98.81. Here's the 200-day. Okay, kind of take out and close above 103 would be important. If it does, that'll help the tech sector, and then your next level comes in around 111.
Microsoft is the next big tech name to report after the close today. It's one we've sort of been talking about that the story is a little bit muddled. They haven't done great with their tablet and their mobile ventures. The stock is still sort of in a lower level base. It pays a nice dividend. It's one that you could have a little bit of a contrarian view on. What do you see from Microsoft? That's something that you're going to be focusing on in the next few days.
I've had this as one of my positions over the course of the past week, thinking that because of what went on with Dell, what happened with Hewlett Packard, that some of these, fundamentally cheap stocks that have a lot of cash, and yes, they're not phenomenal growth stories, but sometimes you don't have to be. And, if you look at it here, it's pretty interesting. I might actually look at it because you have this lower level area, and I don't even know why I got out of it. I think I was just trying to clean up. It held the top half of this channel. Okay, closed strong yesterday. So at this particular point, it has done nothing. So if people are looking for vehicles that seem sort of safe, I guess you could say Microsoft is sort of safe. You have an area that comes in at 31. You have, the 200-day right here. It's coming out of a lower level type of scenario with a gap right in front of it. I'm going to look at it today, actually. If it's down a little bit with Apple, maybe it tries to go positive. And this is something that will probably have a very low premium, for options. So maybe I do some kind of option play just to see if they want to come after some of these behemoth mega caps in the lower end of their ranges, kind of like what they did with Dell and with Hewlett Packard. And then, I guess IBM was pretty much no confidence builder for this one down here.
All right, and to finish things up today, we'll look at a couple of social networking plays. Facebook had a 4-day pullback after the surprise event. They took a page out of Apple's book, and people were somewhat unimpressed by the graph search feature that they unveiled. Had a pullback, but it started to firm up a little bit, and it's starting to tick higher again. What do you see from Facebook, Scott?
I think Facebook has been a great vehicle to see. This is at least something that we gravitated to in the first month that was very tradable, where you had that price point at 24, you had another price point at 28.60, and then it was a nice sell into the event and actually a decent short. For me, unfortunately, I didn't buy it back because I was trying to be too cute. But at this point, it looks pretty good. You look at the chart here, and you will see, we were talking about the cup and handle pattern in here, and this being the cup. This was your handle. Here was your tier 1. When it broke above, it was a nice play. But then it got right to our resistance, or our target even, very quickly. So now, at this point, it's starting to channel again. I think earnings are next week, so we'll be talking about it next week. And, above, if they do some mobile growth numbers, and if they have perceived growth, because there's not a lot of companies out there that have growth, and since it's so new, it could, above this 33.44, and your next level is, comes in here. So I think a lot of people are behind it. There's a lot of big money still in there from the private and this and that. So let it go sideways, and then we'll figure it out. But all in all, a great vehicle for, for 2013 to trade and even hold.
And like you said, earnings will be big for Facebook. They're January 30th, so they're coming up, and that'll be an important report to see if Facebook can grow up a little bit. And the social networking stock that has already grown up and has outperformed all the other ones in the sector has been LinkedIn. That it's been a little bit choppy at these upper levels, but it still remains best in breed and a relatively constructive pattern on a swing trading perspective. What do you see from LinkedIn, Scott?
This is something that I've been holding still, and I know it's like, this is the frustrating part. Like, I've been holding it, and it's been trending higher, and I've been making money, but every time it looks like it's going to go and you add to it, it always has that sneaky pull in, and if you're on the road to trade floor, you know exactly what we're talking about. You buy it, it looks good, and then it pulls in, so whatever you added to it, you get a little worried about, and then it comes right back. But overall, this stock has the ingredients, which I talked about last year, as something to stay put in the drawer because it's got a small float. It's relatively new. New issues that come out within a year to 3 years are typically the ones that have really nice fundamental numbers, and it's actually performed well on earnings. I think this time, if the earnings come in, which I hope they do because I'd love to see another vehicle, I think this one will make new historic highs and could get to like 140 this year. You look at the chart. I know there's still a decent amount of shorts in. This is the old high right there. Couldn't get through it the last time. This was, I think, a level we talked about entering. And here we are back at the highs. So if they come out and they deliver, I think we take out these highs, 125, and it could be 140. For me, though, again, because I'm risk averse, I'm probably not going to take the stock into earnings. I'll get out of my stock and I'll do some kind of call spread. I'm hoping it trades through there beforehand so we could really, get a nice bang for the buck in the equity intraday. But lately, they're not giving us a lot of things that we want. So, we're just going to have to take it as it comes, so to speak.
All right. Well, that'll do it for today's full morning call. We'll see you on the blog and in the virtual trading floor. Good luck trading.